It's Saturday evening, January 18th, 2026, and I'm going to come in hot because what happened on Thursday and Friday wasn't Binyang Shmar, just another strong week. It was the kind of market glitch that shows up right before a sector goes from ignored to unavoidable. If you looked away for a couple hours, you missed the opening crack of what I think could become the most violent repricing the silver mining space has seen in years. Here's the setup. The metal didn't do anything insane. Silver held its ground. But the miners? The miners didn't just move, they detonated. And if you're thinking, all right, John AG, that's dramatic, good. Because it is dramatic and it matters. Once a move like this gets going, the market doesn't send you a polite RSVP later. You either understand the mechanics early, or you end up buying headlines after the easy phase is already gone. Quick favor before we get into the core. My YouTube analytics still show a big chunk of you watch every week and never hit subscribe. If you get value here, subscribe and drop OG John AG in the comments so I know you were part of the real crew. All right, let's walk through what snapped, why it snapped right on options expiration, and why the next couple weeks could get even crazier, especially once earnings start hitting. Also, check the description after this video. I left bonus links there for you, premium WhatsApp channel, and the option to join channel membership if you want the deeper dives. Now picture Thursday, January 16th, monthly options expiration, OPEX. That's the day a mountain of derivative bets either settle quietly or explode loudly. That's the day positioning becomes real, and that's the day I've been telling you to watch, because OPEX is where the market stops pretending. Thursday morning opened like a textbook trap. Fast smackdown, sharp dip. Silver got hit hard in minutes, down a couple bucks in a blink. Exactly the kind of move designed to trip stops, shake weak hands, and keep key call options out of the money. For a brief stretch, it looked like it worked. Price hovered under the level the shorts needed, miners were flat to red, everything got quiet, and the noise machines started warming up. Then the tone changed. Late morning buying showed up that didn't feel like retail. Not a bunch of tiny orders. Real blocks, real size, big prints. The kind of orders that don't care about your feelings and don't ask permission. Silver clawed back. And heading into the close, it didn't just recover, it pushed back above the line that mattered. Silver closed above the key strike zone, and that single fact flipped a chain of exposures from safe to oh no. Because when silver finishes OPEX above a major strike, you don't just get a price move, you get an accounting problem. And markets hate accounting problems. Friday, January 17th, was the confirmation punch. The Silver Miners ETF ripped about 8.3% in one session, while silver itself was only up around 2.1%. Read that again. Miners moved roughly 4 times the underlying metal in a single day. That's not casual. That's not investors feel better. That's forced behavior. That's hedging. That's positioning. That's desks scrambling not to get carried out. And if this is your first time hearing gamma squeeze, don't worry. I'm going to explain it in plain English, focusing only on the mechanics that matter, without turning this into an options textbook. But pause here and ask yourself one question. If miners can move 4 times faster than silver on a day when silver barely moved, what happens if silver actually starts moving? That's the cliffhanger nobody wants to say out loud. Now, the mainstream crowd will try to frame this as a random bounce. Risk on rotation, technical breakout. Whatever phrase helps them avoid the actual story. But the real story is mechanical, and mechanics don't care about opinions. The core claim I'm making tonight is simple. Friday wasn't a one-day wonder. It looked like the opening act of a multi-week, forced repricing that can feed on itself, especially if momentum survives into earnings season and into the next round of hedging. So let's rewind to Thursday, because Thursday is the key to everything that followed. You got that fast, ugly dip, suspiciously timed, right when the market would want to pin an option strike. Price dropped, then stalled. And that stall is the tell. When a market stalls in a strike zone during OPEX, it's usually not natural. It's positioning. For dealers, short call options, the goal is simple. Keep price below the strike so the calls expire worthless. If calls expire worthless, the seller keeps the premium. If calls finish in the money, the seller owes stock or owes hedges. And that's where things get dangerous. When you sell calls, you can end up short gamma. Short gamma basically means as price rises, your risk rises faster than your comfort. So to control that risk, you hedge. And that hedge becomes buying. And that buying pushes price higher. And higher price increases the hedge requirement. That loop is how squeezes are born. Think of it like this. The option seller thought they were selling fireworks in a room with no matches. Then price walked into the matchbox anyway. Now everybody's holding a lit fuse. Here's the part most people miss. Market makers don't hedge on vibes. They hedge on delta. Delta is just the number that tells you how much an option behaves like the stock. Out of the money calls have low delta, meaning the dealer doesn't need to hedge much. But when price climbs toward the strike and moves in the money, delta rises fast, and that forces the dealer to buy shares to stay neutral. So if a dealer sold a pile of calls expecting them to die worthless, they might have been lightly hedged. But when price closes above the strike, they suddenly have to hedge aggressively, meaning forced buying in a short window at the worst possible time. And when multiple desks are in the same position at the same strike, the buying doesn't come gently. It comes synchronized. Synchronized buying is what turns a normal rally into a face melter. That's why Friday matters. Friday looked like the hedging process beginning. And if the underlying stays supported, that hedging can continue. Let me put numbers on it, because numbers separate a squeeze from a fairy tale. On Thursday, the key psychological level was $90, where a huge pile of call options sat, waiting to either die quietly or become a problem. Silver dipped under it early, and for a moment it looked like the pin might work. Then the bid showed up. By the close, silver didn't just recover, it closed around $91.73, flipping a long list of strikes from worthless to valuable overnight. And if you want the timestamp that made my ears perk up, around 9:47 a.m. Eastern, that sudden flush that felt like a stop run. Price slid from roughly $91.30 to about $89.15 in under 10 minutes. Classic shake the tree behavior when someone needs price below a line on a deadline. But Thursday was different because the tree didn't drop the fruit they wanted. It snapped back. Then late morning, call it around the 11:30 zone, you started seeing larger prints, real blocks. Once those hit, the tone shifted from weak to stubborn. By 1 p.m., silver was back over $91, and into the close it held. That close lit the fuse. Now Friday's close is the scoreboard. Silver, plus 2.1% SCL, Silver Miners ETF. Silver 8.3%. That's roughly a 3.95 to 1 leverage move in a single session. And here's the kicker. At these silver prices, the Sector S operating leverage suggests miners can respond even more aggressively. 5.1 or 6.1 in bursts, once earnings confirm margins and once dealer hedging goes deeper. So if Friday was almost 4-1, it's not crazy to ask, was that day one or was that the warning shot? Now let me give you the mechanics in one clean loop. When calls are out of the money, dealers can stay lightly hedged because delta is small. When price moves into the money, delta rises, and dealers must buy shares to remain neutral. That buying pushes price up. More calls move into the money. Delta rises again, dealers buy again. That acceleration is gamma. Gamma is the engine. You don't need a conspiracy. You only need crowded positioning at a popular strike plus a close above it. The math does the rest. Now, because I know the comments are going to be full of, what would you do? I'll give you my framework without telling you what you should do. My first checkpoint is Tuesday's open, because in this narrative, Monday is a market holiday. If SIL gaps up Tuesday and holds that gap through the first hour, that's continuation. My second checkpoint is the $16 zone in CL, roughly where it closed after Friday's rip. If we pull back and that zone acts like a trampoline, that's healthy. If we lose it and can't reclaim it, the squeeze thesis weakens. And if I'm forced to name a hard line, it's around 1450 on CL. A close below that kind of level would tell me the move failed structurally. Not advice, just how I frame risk when volatility gets savage. Then comes the fuel, earnings. Late January is where the market stops debating and starts reading. A big U.S. primary producer is expected around January 28th, a popular high beta name around January 30th. If those reports show the cash flow the margin math implies, that's when analysts update targets, and that's when bigger money starts carrying exposure. Because here's the truth. A squeeze can start a rally. Earnings can legitimize it. A squeeze is a spark. Earnings are gasoline. If both hit together, you get the kind of chart that moves too fast for normal brains to process. So next week, watch the scoreboard. If miners keep outrunning silver, if dips get bought fast, and if we walk into earnings with price holding up, then we might be looking at one of those rare windows where the market hints before it goes fully mainstream. Now let's talk about the other lever, operating leverage. Operating leverage is why miners can outperform the metal massively once price gets high enough. Basic business math. Miners have costs, they sell a product. When the product price rises faster than costs, profits explode. And when profits explode while the stock has been asleep, the stock eventually has to catch up. Markets can ignore reality for a while. They can't ignore earnings forever. Here's the simplified framework. Silver in the low to mid-90s, all-in sustaining costs for many big miners in the low 30s per ounce. At those levels, profit per ounce isn't a little better. It's massive. Now look at how many of these stocks are priced. A lot of them still trade like survivors, not cash machines. That disconnect is the gap. And gaps in markets don't sit there politely like spreadsheets. They tend to close violently, because once the crowd sees it, everyone tries to buy the same thing at the same time. And right now, the crowd still isn't in it. That's the entire point. Now I want to address the skeptics directly, because skepticism keeps you alive. Skeptic argument 1, Costs are rising. Inflation eats margins. Yes, costs rise. Diesel, labor, equipment, all of it. But ask yourself, did costs triple? Because silver went from the 20s to the 90s in this narrative, costs didn't triple. They didn't keep pace with that magnitude, which means margins expanded, cash flow expanded, and valuations that assumed pain start needing to assume profit. Skeptic argument 2, governments will take the profits. That risk exists, but two things matter: timing and diversification. Policy takes time. Markets can reprice faster than governments can legislate. And major miners are usually spread across jurisdictions, not trapped behind one single political button. Skeptic argument 3, big players won't allow the rally. They'll smash it again. I get the cynicism, but even rigged games still obey physics. Physical supply, physical demand, physical delivery, hard constraints. If paper positioning stretches far enough, stress shows up. And when stress shows up at the wrong moment, like OPEX, things break. Now, let me throw in something for the story lovers. If you want silver-related success stories, real people, real wins, real lessons, there's a link in the description to another channel that focuses on that. If that's your thing, subscribe over there too and binge it. All right, back to the squeeze. What makes a gamma squeeze special is that it can become a feedback loop. Buying forces, more buying. Hedging triggers, more hedging. That pulls in momentum algorithms. Algorithms trigger stops on shorts. Shorts cover. Covering pushes price higher. Higher price forces even more hedging. That's why I'm not treating Friday as just a green candle. Friday looked like ignition. So what would confirm this isn't noise? 1, continuation, especially if miners keep outperforming the metal. If silver is up 1% and miners are up 4% again, the lever is still active. 2, dip behavior. In normal markets, dips linger. In squeezes, dips get swallowed. Buyers show up fast because hedgers need to buy weakness. 3, earnings season. Earnings force the narrative to change. You can hide from charts. You can hide from vibes. You can't hide from cash flow. Late January, we'll likely see major miners report Q4. If those results match the margin math, analysts will be forced to update models, funds will be forced to rebalance, and that creates another wave of buying that can stack on top of squeeze pressure. Now let me lay out the sequence I'm watching step by step, because clarity beats hype. Step 1, OPEX pin attempt fails. Price closes above the critical strike zone. That happened. Step 2, dealer hedging kicks in. Miners explode relative to metal. That happened Friday. Step 3, the market tests whether the move is real. Either it fades fast or it holds and attracts momentum capital. Step 4, earnings pour fuel on it. If earnings surprise, the repricing becomes fundamental. Step 5, once the crowd shows up, the move turns reflexive. Ugly green candles, price action that makes no sense until you remember forced buying doesn't ask permission. Here's where people get hurt. They wait for mainstream coverage. They wait for safe entry. They wait until their whole feed is talking about it. And by then, the easy phase is gone. So I'll ask you a question for the comments. Do you want updates on silver miners only after the move is obvious? Or right when the mechanics flip? Tell me which you prefer and why. Second question, what's your biggest mistake in past bull runs? Buying late, selling early, or getting shaken out by fake dips? Drop it below. Your answer might save someone else. Now I'm going to spotlight the leverage gap again, because this is where things go viral when people finally connect the dots. If miners moved nearly 4 times silver on Friday, that's the market waking up to the profit explosion inside these companies. But the math says leverage can go even higher at these silver prices. Meaning Friday, loud as it was, might still be the start, not the peak. That doesn't mean straight up. Squeezes are ugly. They whip, they shake, they try to break you emotionally. Structure is what matters. Higher lows, violent rallies, fast dip buying. What's the catch? Every trade has one. The catch is volatility. The catch is headline risk. The catch is the market trying to scare you out right before the next leg. The playbook is predictable. After pop, you'll see overbought warnings, take profits pieces, rally is done, hot takes. The goal isn't T to inform you, it's S to get you to sell so someone else can buy. I'm not saying every candle is a conspiracy. I am saying Fox watch the emotional cycle repeat for years. Early rally gets dismissed, continuation gets doubted, then late stage hype arrives, and that's when the crowd buys tops. So what's the smart approach? Focus on mechanics and levels, not emotions. I'm not your financial advisor. I'm not telling you what to buy. I'm telling you what I'm watching. If miners hold breakout levels and dips get bought quickly, that supports the squeeze narrative. If the move fails and closes back under key levels for multiple sessions, that tells you ignition fizzled. But right now, the evidence points to ignition. Now, the part mainstream avoids? Why now? The simplest answer, positioning plus stress. Options exposure was stacked. Price refused to break down. That forced hedging. Once hedging started, the sector reacted like a compressed spring. And there's also the bigger backdrop: physical tightness and premium behavior. When physical premiums stay elevated, it signals stress in the supply chain. When exchange inventories trend down over time, that's another stress signal. Stress doesn't guarantee a moonshot tomorrow, but it raises the odds that paper games slam into reality at the worst possible moment. And OPEX is one of those moments. Now, since we're talking about staying ahead of the herd, here's where the deeper resources come in. If you want more detailed breakdowns and research we don't always put in public uploads, we also offer members-only videos. There's a separate team on those, and they go heavier on the digging. Those are for premium members who want more than surface-level recaps. Again, the description has bonus links, premium WhatsApp channel, and the membership option. And I want to speak directly to the people who are actually winning, because you are one of the most underused weapons on YouTube. If you've had a win, nailed a trade, built a stack, grew income, whatever, share it in the comments. Seriously. Real wins lift morale, and they give the community proof that discipline works. All right, back to the market story. When miners lag, it frustrates people. They watch silver run and wonder why equities don't move. Then when catch-up finally starts, it's so fast it feels unfair. That's the historical pattern. Metal leads, miners lag, then miners sprint. In previous cycles, you saw long stretches where miners chopped sideways while the commodity climbed. Analysts stayed cautious, funds stayed underweight, retail ignored it, until earnings proved the margins. Then the re-rating hit. Then the move went vertical. That's why I keep circling back to earnings season as the next big catalyst. Earnings don't care how many times someone says overbought. Earnings are numbers. Here's a simple valuation thought experiment. Imagine a miner producing tens of millions of ounces, selling into a 90s price environment with costs in the 30s. Per ounce profit becomes massive. Multiply by production, and you get a profit number that can make the current market cap look tiny. When a company generates huge profit and trades at a cheap multiple, one of two things happens. Either profit collapses or the stock reprices higher. If silver holds, profit holds. If profit holds, the multiple eventually expands because investors chase earnings. Now timing. Next week has a holiday Monday in this narrative, which compresses hedging into fewer sessions. Fewer sessions with the same pressure can create more violent daily moves because dealers can spread their buying out comfortably. Tuesday becomes key. If we get a strong open and miners hold gains through the first hour, squeeze pressure is likely still active. Midweek is usually when the counterpunch comes. If someone wants to stop a run, they hit it when enthusiasm is high. Engineered dips meant to shake out late buyers and scare early ones. If the move survives that counterpunch, you're probably not dealing with a cute bounce. You're dealing with a real repricing. Now the media silence effect, without naming outlets, because the pattern is bigger than any one brand. When a story doesn't fit the comforting narrative, it gets minimized, ignored, pushed aside. Then when price gets too high to ignore without looking stupid, coverage suddenly appears. Articles pop up. Panels talk. People who didn't care last month become experts overnight. That's when retail piles in. So if you're watching this before the loud coverage arrives, you have a window, not a guarantee, an advantage. Zooming out. Silver demand isn't one country. Industrial demand doesn't stop because a chart looks overbought. Monetary demand doesn't stop because an article says, take profits. Once a global bid is there, paper can mask it only so long. Which brings us back to positioning. When commercial traders, market makers, and hedgers are net short huge size, their betting price won't run too far too fast. If price runs anyway, the net short becomes a trap, and traps create squeeze events. Here is what I want you to understand deeply. Squeezes don't end because you feel good. They end when forced buyers finish buying, or when price breaks down hard enough to push options back out of the money and release hedging pressure. So you track a squeeze by tracking mechanics. Are key strikes still in the money? Are miners still outperforming? Are dips getting bought fast? Are earnings likely to confirm margins? If those stay, yes, the squeeze has fuel. Now what you should not do, don't let one green day make you cocky. Don't let one red day make you panic. Don't size trades based on excitement. Don't ignore risk management because you saw a screenshot online. Squeezes are the fastest way to make money and the fastest way to lose it. The difference is discipline. Now let's bring you back into the conversation. If you've been watching silver and miners for a while, tell me, what was the first sign this week felt different? OPEX rebound? Miner outperformance? Unusual volume? Be specific. If you're new, tell me what you're trying to learn. Options mechanics, mining fundamentals, or just how to avoid getting played by emotion. I read these. They shape what we cover next. And I'm serious about success stories. If you've had a win, stacking, debt paid, emergency fund, better job, drop it below. Doesn't need numbers, just the story. Now let's rerun the logic chain one more time, quickly, because repetition locks it in. OPEX created a choke point. Price got attacked early. Price recovered and closed above the level that mattered. The close pushed calls in the money. Calls in the money forced delta hedging. Delta hedging forced buying. Buying made miners outrun the metal. That outperformance signals the lever is active. Earnings next week could pour fuel on it. That's the structure. Now, possible next moves, and I'll be blunt. If this continues, it'll get emotional. We could see gap ups that make people feel like they missed it. We could see intraday dumps that make people feel like it's over. We could see fear headlines designed to shake you out. We could see too late comments from people who never ran the math. Your job is to stay centered and track what matters. Here's what I'm watching over the next 2 weeks. 1, whether silver holds the high zone. Miners can't sprint forever if the metal collapses. 2, whether miners keep printing 3.1 or 4.1 days implies hedging pressure is still alive. 3, whether volume stays elevated. Squeezes need participation. 4, how earnings are received. Good earnings can still sell off if expectations got too hot. Another angle, valuation versus broader markets. A lot of broad market stocks trade at expensive multiples because investors pay for growth stories. Miners, even when profitable, often trade cheap because investors fear volatility. That cheapness is why they can pop so hard when sentiment flips. So when you combine cheap multiples, exploding margins, and a mechanical options squeeze, you get a setup that can move faster than people think is possible. And I will be honest, the people who win these moves are usually positioned before the breakout. That's why I've been hammering mechanics, not headlines. But even if you weren't early, you can still avoid the biggest mistake, chasing the top of one candle. If you're late, you wait for the market to offer a better spot, support, consolidation, dip buy confirmation. Because if this is truly a multi-week repricing, it won't be a single candle, it'll be a sequence. Quick CTA that actually matters. Subscribe so you don't miss the next update, because in moves like this, timing is everything. One more thing people forget. When miners rise, they attract stories. Stories spread faster than spreadsheets. When the story spreads, liquidity changes, volume changes, and the move can accelerate. That's why phase 1 is quiet and technical. Phase 2 is loud and emotional. We're right on the edge between those phases. So if you're watching this now, you're early enough to learn, early enough to prepare, and early enough not to be the person who notices only after the crowd shows up. You might be wondering, John, what's the one thing that would make you change your mind? For me, it's simple. If miners give back the move fast, close back under key support for multiple sessions, and the metal can but hold its own support, that tells me the squeeze pressure didn't have enough fuel. But if we consolidate above the breakout and earnings support the margin story, then the path of least resistance stays up. Final thought, take this seriously. The market doesn't ring a bell when suppression breaks. It just stops working one day. And when it stops working, the move isn't polite, it's violent. Friday looked violent. That means next week could be the week where people realize they re-underexposed, and they all rush in at once. Don't forget to check the description for the bonus links, premium WhatsApp channel, membership option, and that Silver Success Stories channel. I'll be back with updates as this develops. Until then, keep your head straight, track the mechanics, and don't let the noise trade your account for you. And seriously, drop your thoughts below. Are we watching the start of a real multi-week repricing, or do you think the market tries one more big fake out first? I want your call in the comments. And if you think this is already big, wait until the next options wall gets crossed.